Welcome back to the Retire Young radio show. I am your host, Joshua David, having a good time in the studio with my great friend, my great pal, and Mr. Workout. You've been working out a lot, haven't you?
If you count walking from the couch to the refrigerator and back working out, I've been doing that a lot.
Good enough for me. If you're just tuning in, Al was shedding some light on, first off, how the market works, but also what's happening in these markets with earnings. There's different opportunities that's out there for us, the public, but how to protect your gains. It's, you have to have the right mindset, and you want to be the house. You don't want to be the person that is on the other side of the trade. And then trading is a skill. It's not knowledge. So once you understand the skill of how the institutions or the smart money moves the market, you want to trade like them. So Al, as we get into this next segment, we have a lot of listeners that want to understand, why and how the smart money is always so successful, how they're always so profitable in these markets. And they're sometimes, probably all the time, they're doing something a little bit different than what the general public is that, gets their information from news and books and all that junk that's out there. So let's talk about why and how the smart money is so successful in their trading and investing and how they're creating income, but also how can us as investors do that same thing?
Yeah, and first of all, there are two things that you said I want to comment on. You've used the word skill several times, and skill is really a critical component of for trading and investing. Knowledge is one thing, but the skill to use the knowledge is what's really important. The skill is something, nobody is born with the skill to do this. It's something that you practice, that you learn. It's based on repetition of something that is working on a consistent basis. And then you also mentioned the word profit. Every time a profit is taken away or gets hit, your portfolio or your asset has to work harder just to get back what was lost there. So being able to identify a realistic target, a profit target, is very important. Now, let's get down to what the smart money is doing differently. And as I mentioned in that first segment, somebody's making money on a consistent basis. It's the smart money. So what are they doing? Number one, they have an unfair advantage over us, and that is the fact that they are spending probably tens of millions of dollars a year on research and data that we either don't get or we get it too late to really do anything. So instead of trying to wait for that data to make a decision, why not do what the institutions are doing, because they are acting on the data and the research before it becomes public, if it ever does.
Yeah, and think about that. Things that come up, just to shed some light on that, a lot of people base their investment decisions off what's happening in the news, what they hear, right?
Sure.
Now, do you think the smart money is going to let their hands show before it happens? They're going to do their, what happens. They're going to create those moves and then publish that news.
Well, and that's a good point. That brings up something I wanted to talk about anyways. Warren Buffett, a number of years ago, put together a 64 million share position in IBM, but he had to do it over about a 7 or 8 month time period in increments. And then when did he announce the fact that he had done that? After all 64 million shares were actually
that.
Right. Then people say, hey, I better get in on IBM. So they jump in after all of the movement of that stock caused by Warren Buffett's buying has already taken place. And the same thing, the institutions do that. The hedge funds do that. They will tell you what they have bought or sold after they've already done it. If you understand how to identify when price is going to change for an individual asset or the markets in general, then you can participate along with the institutions instead of waiting until after they've done that.
It's just about being more proactive as well.
It's being proactive, exactly. Now, another thing that the institutions do, they understand that they are not going to be successful 100% of the time. So they are really good at understanding how to protect their investments and protect their profit. Number three, they know the market doesn't just go up. There's three directions the market can go. It can go up, down, or sideways. And the smart money understands that there are opportunities in all three directions. And unfortunately for most of their clients, they put them into a portfolio that only makes money in one out of three directions.
And think about that, too, because, the public is being put in something totally different that they're doing in their accounts. Talk a little bit more about how that down market works.
Sure. In a down market, there are assets or strategies that you can use or that can be used to participate successfully in a downward market. You can short the market. You can short an asset, which is basically selling something Typically, when you get involved in an investment, you buy it and then with the goal of selling it at a higher price. In shorting, you are selling it first, borrowing something you don't own, selling it with the goal of buying it back at a lower price. That can be done with individual assets and with the markets in general. That's one way of making having a participation in the downward market. It can be shorting. It can be options. There's an option strategy that will benefit in a down market. They're what we call inverse ETFs, which should go the opposite direction of the underlying. And the institutions are using these things on a regular basis. But what they're doing is they're putting their clients into mutual funds, maybe some stock, maybe some ETFs or annuities, but they're also trading and investing in what we call the leveraged assets, futures, Forex options. So that's number 4 for what the smart money does differently. They use different assets and strategies, and everybody should be looking at really two different ways of investing or being in the market. One is for short-term additional cash now, and one is for long-term building of wealth.
Now think about that for a second. Now, a lot of investors, a lot of people listening probably think, and they've heard this so many times, we're in it for the long haul, which means they're buying positions and they're holding them for a long time. Now, you were talking about the smart money, how they're creating income as markets go down. So let's think about this now. In February, middle of February to the middle of March, the market went down a lot.
About 34%.
About 34%. And now it's taken from the middle of March to August, which is what, 4 months? March, April, May, July, 4 months. 4 months to get back to where it was. So in that 1 month as it went down, there's opportunities as it goes down. So what's happening with the public is they're missing out on all these phenomenal opportunities because, Al, does it go up faster or does it go down faster? We know.
It goes down about 3 times faster than it goes up.
It does. So there's opportunities no matter what this market does, whether you're on a short-term basis, weekly or monthly, or a longer-term basis, yearly. So, Al, you talk a lot about multiple directions and how the markets work in up and down markets, but how us as investors can really participate no matter which way this market goes, because the markets are at all-time highs. I mean, there's times where investors want to be able to understand how to take profits, and a lot of people just don't know how to do that.
Sure.
Al, so we understand there's 3 directions in the market. There's up, down. There's also sideways, which we'll talk about more probably on the next segment. But there's we talked a lot about the stock market, how you can create income using the stock market. There's also other assets out there where you can use a fraction of the capital because you have leverage. Okay, now think about that. If there's leverage in your trading and investing, we all use leverage in our everyday life. People that have homes use leverage. It's a mortgage, right? You use a small down payment or have capital set aside to control a much larger asset. And you can do the same thing in the trading and investing world. So let's talk about those leveraged asset classes, Al.
Right. When we started talking a little bit about long-term and short-term, if you are looking at benefiting from the markets on a short-term basis, stocks are probably not the first choice. They're the best asset for long-term buildup of wealth, building up of your retirement accounts, but they are designed or really intended to be looked at as a long-term hold. And that's what you're told. Most of the financial advisors will tell you, put together a portfolio and look at it as a long-term thing. I mean, multiple decades that you hold, and you don't worry about the drawdowns, don't worry about the crashes and corrections, which we totally disagree with. But if you need to have access to cash on a short-term basis, you can't look at something that's intended to be held for multiple decades. The leveraged assets that you're talking about, in addition to having leverage, which really means that you're increasing the buying potential, the buying power of every dollar you have, but they also are great for short-term trading. Futures, for example, the futures market is probably the best short-term trading vehicle. And in that market, you're trading a number of different things. A lot of people say, well, with the cost of some of the stock right now that maybe are, $300,000, $400,000, $500,000, $2,000 a share, I can't afford to participate. Well, with these leveraged assets, one of the great things, and even the institutions use these on a regular basis, but we all have access to them. The brokers will allow for a smaller amount in a portfolio, but with the ability of controlling a much larger investment because of that leverage. Futures, probably the best trades for short-term, daily, weekly income. And there you're trading.
And that's why the smart money is using that consistently.
Right, because they're not doing a buy and hold strategy for their short-term income, their short-term cash. They're using assets like futures, forex, and options. And with futures, you can trade the major stock markets, you can trade commodities, currencies, interest rates, precious metals, oil, a number of different things. Probably the best diversification vehicle that there is. And they trade 23 hours and 45 minutes a day. So you have a lot of versatility time-wise. And look at somewhere between a 20 to 1 to maybe 100 to 1 leverage there.
Now, to clarify, did you say they're open around the clock?
I did say that.
So investors can participate in the evening if they want to.
Absolutely. In the evening, early morning, during the day. A lot of people are working the 6.5 hours that the stock market's open, which makes it harder for them to participate. You don't have to. These markets are trading around the clock, which also gives you an advantage as far as the potential to not have what we would call a gap. Like companies typically report their earnings either before the market opens or after the market closes. Let's say that a company comes out with a terrible earnings report after the market closes. 100%. The next day when the market opens, it's going to open down. The stock will open down, gap down, which means anybody that owned the stock at a certain price when they went to bed now owns it at a much lower price in the morning. That's a gap. If a market's open almost 24 hours, like the futures market, the possibility or the potential of that happening is very, very minimal. So great short-term trading vehicle, great leverage, 23 hours and 45 minutes. That's one great leveraged asset. The foreign exchange market, the Forex market is another 50 to 1 leverage. It is open 24 hours a day.
Yeah, we can cover that Forex market on that next segment because a lot of people, we're going to get into more on retirement, and that's a longer term, I guess we'll say a nice moving market for that. But think about this. Us as investors, we have the opportunity to use leverage. We use that in everyday life, mortgages, credit cards, car loans, all that stuff. But everybody is scared to do that in their investments. Well, that is where you should be doing it because the brokers require less capital. Think about that. They require less. But also, they're open around the clock, 24 hours a day roughly. So that gives us an opportunity to trade and invest when we can. Say we worked in the day, we can participate in the evening. Why? Because it's actually open. And these are great markets to get into, really just to understand, but also how to diversify your portfolios. So, Al, you talk a lot about these other asset classes, included the stock market, and how the smart money is creating income in their accounts no matter which way this market. Al, in this next segment, I really want to cover and just really dissect retirement accounts, retirement strategies, and concepts that the smart money is using in their accounts. Because a lot of people, we talk about this a lot. There's a retirement crisis here in America. People can't retire. If they do, they're sometimes only living off Social Security. But the smart money, they always have capital. So let's talk about retirement in the next segment. This is Josh and Al with the Retire Young radio show. We will be right back.